Welcome back, everyone, to this emergency market update. And I'm calling it an emergency because what we're seeing in the markets right now is not normal.
This is the kind of movement that usually only happens during inflection points. Those rare moments in financial history when something big is shifting beneath the surface, and most people realize
it only after the move has already happened.
Today, we're talking about AI stocks tanking Bitcoin, selling off aggressively, liquidity drying up, and a potential correction spreading through the market like wildfire. And the most important part, Bitcoin started falling before everything else again. And whether or not you're a Bitcoin person, whether or not you own crypto, whether or not you ever plan to own crypto, this is still something you absolutely need to pay attention to.
Because historically, Bitcoin tends to move first. It is a leading indicator for liquidity, for risk appetite, for institutional behavior, and for macro shifts.
And once again, Bitcoin flashed a warning sign that the rest of the market is just now catching up to.
So today, we're going deep, not just reading headlines, not just reacting emotionally, but actually unpacking why this is happening.
Because once you understand what's really driving this sell-off, you'll understand whether this correction is a temporary panic, a healthy reset, or the beginning of something bigger. And trust me, the theories behind this sell-off are some of the most interesting we've seen in years. Part 1, the sell-off begins. Let's start with the obvious question. Why are AI stocks crashing?
Why is Bitcoin crashing? Why is everything suddenly red?
At a surface level, people will blame interest rates, inflation, liquidity issues, geopolitical tension, profit taking, and yes, all of those things matter.
But what makes this moment special is that the sequence of events is different. Bitcoin fell first.
Then AI stocks, then the rest of the market, and when the risk gone leader falls first, it usually means something deeper is happening.
Because Bitcoin is unlike any other asset, it trades 24/7. It responds instantly to liquidity changes, and large holders move markets with incredible speed.
When Bitcoin tanks before tech stocks, it means the drop wasn't caused by earnings or news or hype dying. It was caused by something structural. Something under the surface, something the average investor can't see yet, and that's why this move matters so much. Part 2, the most interesting theory. There are several theories floating around, but the most interesting, at least to me, is the one coming from a purely technical perspective.
And to be clear, I'm not talking about astrology, a meme technical analysis.
I'm talking about the macro trend structure of Bitcoin. The pattern that has been consistent for more than a decade.
The theory goes like this. In every Bitcoin market cycle, when the price drops below the 50-week moving average, the bull run is over. The party ends, liquidity slows, the hype fades, and the market resets. This 50-week moving average isn't just any line.
It's the heartbeat of the cycle, the dividing line between euphoria and reality. And guess what? Bitcoin just broke below it.
And not by a little, it fell solidly through it. This is the moment many long-term investors watch very closely.
Because historically, every time this line breaks, a cascade of selling follows. Not because people panic.
Not because they're emotional, but because to them the prophecy is fulfilled, the signal has been given.
The cycle has ended. The rules say, time to sell.
And that's exactly what happened. A cascade of algorithmic selling, fund rebalancing, and large holders exiting their positions started the chain reaction.
And once that began, everything else followed. AI stocks, high, growth tech, small caps, risk assets, even parts of the bond market. This wasn't random, this wasn't emotional, this was structural. Part 3, why $13,000 matters now. Here's the crazy part.
The approximate 50-week moving average for this cycle sat around $13,000. Yes, 13,000, a number most people haven't even thought about in years.
When Bitcoin crossed below that level, the people who live and die by this technical rule got their signal. This is why I call it the prophecy moment, because to those investors, the long-term cycle traders, not the short-term day traders, the breakdown wasn't a bearish sign, it was confirmation.
The final piece, the moment the cycle flips. And once the cycle flips, all hell breaks loose. Because these people don't sell small amounts.
They sell big, they don't move slowly, they move instantly, and they don't wait for confirmation. The signal is the confirmation.
So once that line broke, once $13,000 was crossed, once this multi-year threshold was gone, the cascade began.
Part 4. Why Bitcoin leads the market. People always ask, why does Bitcoin fall first? Shouldn't tech stocks lead? Shouldn't the Nasdaq be the signal? No.
Bitcoin is the signal because Bitcoin trades 24/7, reacts instantly to liquidity, is held by the riskiest, most forward-thinking investors, has the deepest on-chain analytics in finance, has whales who can trigger billions in minutes, is basically a liquidity thermometer. Bitcoin is like a pressure valve for the entire financial system. When liquidity tightens, Bitcoin cracks first. When liquidity expands, Bitcoin pumps first. When markets are fearful, Bitcoin shows it immediately.
When markets are euphoric, Bitcoin exaggerates it, and right now, Bitcoin is screaming that something shifted.
Part 5. The 3 big theories behind the crash. There are 3 main theories people are debating right now.
All 3 are fascinating. All 3 could be true simultaneously. Theory #1. Liquidity is drying up. Central banks aren't tightening officially, but liquidity is quietly draining from the system.
This is why borrowing costs rising, big funds reducing leverage, corporations slowing buybacks, geopolitical stress increasing capital stress, investors moving into safer assets. Liquidity doesn't
Disappear loudly, it disappears slowly, then suddenly, and Bitcoin felt it first. Theory #2, AI bubble rotation. AI stocks have been carrying the entire market for months.
But here's the problem. When too much money goes into too few stocks, any small correction turns into a big correction.
And when the AI sector started taking profits, it triggered selling across every correlated asset, including Bitcoin, which has been tightly linked to the tech sector. This is not the AI bubble popping. This is the AI sector cooling off after overheating, but the impact is huge. Theory #3, Bitcoin cycle confirmation. This is the most interesting one. The break below the 50-week moving average wasn't an accident. It was a cycle reset, and once that cycle reset happened, the liquidity that was pushed into high-risk assets like Bitcoin and AI rotated out.
And when the riskiest assets sell off first, the rest follows like dominoes. Part 6. The domino effect. After Bitcoin dropped, AI stocks dropped.
Semiconductors dropped, tech indexes dropped, small caps dropped, even commodities felt it. This is what happens during liquidity shifts. People don't sell what they want to sell. They sell what they can sell. And the most liquid assets get hit first. Bitcoin is extremely liquid. AI megacaps are extremely liquid. Both took the hit and everything else followed. Part 7. What happens next? This is the big question. Is this the end? Is this the beginning, or is this just a temporary panic? Here's the honest answer. We're at one of those rare turning points. The market has to choose one of 2 paths. Path A, controlled correction, BTC stabilizes, AI stocks consolidate, liquidity slowly returns, soft landing narrative continues. This is the optimistic one. Path B, a full correction, BTC forms new cycle, lows, AI stocks retrace to fair valuations, the Nasdaq enters a deeper pullback, liquidity tightens further. This is the realistic one.
Path C, black swan, something breaks, a bank, a big fund, a liquidity pool, a geopolitical event.
Bitcoin signaled stress early, but nobody knows how deep it runs yet. Part 8. What smart money is doing right now. Big players aren't panicking.
They're reallocating. They're reducing leverage, taking profits, increasing hedges, rotating into cash, moving into short. Term treasuries waiting for clarity. This is classic risk-off behavior. When the big players retreat, volatility increases. Part 9. What you should do right now. I'm not giving financial advice. But here's how smart investors think during these moments. 1. Don't panic sell. Panic is the enemy of good decisions. 2. Don't YOLO buy dips blindly. Wait for structure.
Wait for confirmation. 3. Increase your cash position slightly, optional but smart during uncertainty.
4. Watch Bitcoin. It will tell you when the liquidity cycle flips again. 5. Watch AI stocks. If they stabilize, the market stabilizes.
6. Stay calm. Corrections are normal. Cycles are normal. Markets breathe. Part 10. Final thoughts. What's happening right now is not random.
It's not chaotic. It's not the end of the world. It's a cycle shift.
And Bitcoin, once again, is leading the way, telling us that the good days of this phase are cooling down, that liquidity is shifting, that risk appetite is resetting. This is not the death of crypto, it's not the end of AI, it's not the collapse of the market, it's the transition between cycles.
And the people who understand these transitions, the ones who stay calm, observe, learn, and position smartly, are the ones who come out ahead every single time.
Stick around, stay level-headed, because this is not the end. It's the beginning of the next chapter.